Good evening, this is Ken Long from Tortoise Capital, continuing our discussion on market and sector classification and some useful mental models for thinking about how the market and the sectors and the stocks work together and our general approach. The first model that we use is the Morningstar style cube, where we look at the U.S. markets through the lens of large, medium, and small cap, across the value, blend, and the growth domains or styles, and then looking at performance categories inside each of these, performance statistics inside each of these categories. ETFs live in one of these boxes. Now there are some that span, like if you took the Russell Small Cap IWM, it really includes both value, blend, and growth, or all three. U.S. large caps in the S&P 500 span value, blend, and growth. The Russell 400 mid caps also, and so it can be useful to look at value style that incorporates large, medium, and small as well. So you can get individual boxes reflected in a single ETF. You can get a region of boxes organized in the same way. And so by understanding that the performance of a target, whether that's a company or an ETF, is driven by the current conditions that enable that style to work, you realize that when large cap value is going up, everything inside that category is going up, not because of individual company performance per se, but that the sum total of companies in that category are being favored by the kinds of economic conditions that are underway. You find that when the sector is up, the whole sector is up, and there is some individual variations in performance there, but by and large, the sector and the market condition itself contribute much more to the overall results. And so you can find some differentiation among companies, and you get rewarded for doing that if you can find those opportunities. But if you get the market and the sector right, then getting the company target correct is really a way to add icing to the cake. So the Morningstar style cube helps us examine the world through that two-dimensional lens. In this model, we're looking at the efficiency of hierarchy by using a top-down approach. And so if we can get the market correct, get the market call correct, then we're going to get most of the payoff for that amount of analysis. And then if we break down the U.S. into the three primary indices here, the Dow, the S&P, and the NASDAQ 100, representing the universe of large cap stocks. And then you can further subdivide those large indexes into business sectors. And so, for instance, in the S&P 500, there are 9 sector spiders. So if you took each of the 500 companies, it would fit into one of those ETFs, and that's the XL series, like XLB, basic materials, XLE, energy sector, XLF, financial sector, and so on. And so you can actually see how performance cycles in between these different sectors based on the rotation of money at the institutional level. We can then think of mid caps and small caps down here in the companies sector. You might find ones that are more aligned with the Dow performing stocks more on the value side, and then those in the NASDAQ will also include some small caps and mid caps and large caps, although all the members of the S&P 500 are large caps, so you don't see anything in here. But the idea being that you will see sectors come in and out of favor as the indexes come in and out of favor, as the U.S. component of the world market model comes in and out of favor, as the market itself goes in and out of favor. So this is another way of considering how that the differentiation in the Morningstar cube can also be reflected in our ability to drill down from the market to the side of the model that seems to be working best until we find companies, if we want to go that far, that are outperforming their peers, which are outperforming their sectors, which are in the favorable index for the U.S., and maybe the U.S. is favored over the globals, So we need something that allows us to drill down and find those targets and exploit those performances. So now what we can think of as an investor is we can look at exchange traded funds, each with its own idea. Each one of those ETFs is a set of rules that goes into the market to buy things of a certain type. And so we can buy that ticket and get the performance in a single ETF. If it's an actively managed ETF or an actively managed mutual fund, then one of the things we can do is not try to figure out why these things are happening over here, but simply focus on the relative performance of these managers or these ETF sectors and their strategies, and simply own them more or less on the basis of their performance compared to their peer groups. And so we can manage a much smaller subset of symbols and not have to try to master the complexity and chaos that is the global markets. So if we were to apply that to the Morningstar style box, which we do, we assign each one of these ETFs to be the representative of these members of the world market, of these regions in the world market model. And as those perform, then we can see where the trends in the market are. We can use that to help guide our asset allocation decisions and look for exploitable moments. In a similar fashion, we extend that. We take that Morningstar style box and then we apply it over here into the U.S. market. And so when we look at the world market model, we start with the U.S. and there's our style box: large, medium, small, value, blended, and growth. We look at Asia, we look at Europe, we look at Latin American emerging markets, and then we drill down into individual countries. So Asia, we're looking at these symbols. Latin America emerging markets, we're looking here. The countries of Europe, and then this fourth category up here of other asset classes: commodities, oil, gold, treasuries, corporate bonds, U.S. real estate. Each of these being represented by a very liquid ETF, which now is the placeholder for the performance of that overall sector, and then we do some calculations to rate their relative strength on the basis of performance over time on a scale of 0 to 100, and then we categorize those as green is exceptionally good, red exceptionally bad, white above average, yellow below average, and use that as a way to differentiate between performances in these broad indexes, these country markets, and across the world market model as well. Over here in the business sectors, these are the 9 segments of the S&P 500, the XL series, and then their global counterparts. And in the Morgan Stanley universe, the utility sector in the global is broken out between utilities and telecom. In the U.S. model for the Standard & Poor's, the utilities includes the telecom. That's why you don't see a counterpart here for the U.S. We've been tracking currency ETFs as well. They don't seem to be as liquid as being currencies anyway, but we do like to keep track of the relative strength of the dollar against baskets of available currencies. The final mental model I want to talk about is the overall business plan or your financial plan. In my view, those core beliefs that you have get expressed in the areas of equities, real estate, and business. And the purpose of having bulletproof plans with insurance in all of these areas is so that you can endure bad weather in each of those regions. That when equities are bad, maybe real estate is good, or when business is bad, equities are good, and so on. So we want an integrated set of beliefs that allow us to behave in a tortoise-style manner in each one of those areas, and that is slow and steady wins the race, disciplined preparation and follow-through, performance improvement by studying results, frequent metacognition and self-reflection and journaling, and cooperation and research with trusted others. All of these things allow us to endure stormy weather by creating belief sets and robust systems that perform in all kinds of weather. So we care about being able to endure bad results or losing streaks or the opinions of experts who disagree with our belief sets, or the billions of dollars spent on advertising saying you can't do this alone, or commentary in the media that tries to explain the markets but without the basis of a sound theoretical model. Dealing with our own self-doubt and emotions, the problems of too much success or too much failure or too much guilt about the performances we're getting. All of those things are potential upsetters of the apple cart. And so we want our internalized belief systems and performance systems to be bulletproof, to allow us to survive and thrive in the middle of stormy weather.